Hey guys, it's May from Markets with May, and this is episode 2 of Why is the SEC suing Binance and Coinbase? Now, in the last episode, we talked about staking as a service, which is the security that the exchanges are offering without registration. And that's kind of clever because then they don't have to fight with the CFTC as to whether or not different crypto coins themselves are a security. In this episode, we're going to talk about the second item that the SEC is very upset about, which is given that you're doing staking as offering of a security, you need to register if you're going to do that business onshore as a broker-dealer, exchange, and clearinghouse. And by way of implication, you're going to need to separate the three. And while we'll discuss why that is in this episode, we'll go through it in a lot of detail in episode 3. Episode 3 will specifically talk about what the whistleblowers are saying Binance is doing that is incredibly market manipulative. Episode 4 will go through what Coinbase is being accused of and compare it to the differences given the whistleblowers and Binance. And episode 5 will then talk about the 3 different types of crypto coins that are also discussed, but really a secondary component of both lawsuits. Before we get into that, like, share, comment. I love it. It helps me know what media to create. Also, I am currently long BITO, which is a Bitcoin ETF. I do own some Bitcoin through Satoshis. I do own Ethereum and XRP. And I have been short Coinbase. I've actually also been long Coinbase at different times. Currently, my bias is to short Coinbase. So by the time you're watching this, if I don't see better information coming out of Coinbase to clarify why they're doing what they're doing, that's my bias. So now let's get into why the SEC is upset that neither Binance nor Coinbase have registered their broker-dealer, exchange, or clearinghouse. The way I'm organizing this episode best I can is I'm going to go through what each of the 3 entities do. Then I'm going to talk about why it's relevant to register. A lot of that stuff is behind the scenes, so people don't realize this is happening on investors' behalf. And then finally, I'm going to talk about what could go wrong if you fail to register. And on this one, you can kind of think FTX Ledger X versus FTX International. Now, I will preview a little bit of what the SEC thinks Binance is doing, given what the whistleblowers have said and what FTX has said, but really that's going to be more episode 3. So most of us wouldn't realize that the broker-dealer, exchange, and the clearinghouse are separated from each other. In fact, from the time you put in a trade, it gets executed and ends up in your account, there are 3 organizations, each regulated separately, that are involved for you to have bought your shares of something. Now, the typical person is going to type in what they want to transact into a broker-dealer, and the broker-dealer will post it to an exchange where multiple parties can then decide and determine the best price. So for example, a stock like GameStop or AMC, you would put the order in with your broker-dealer, would post the order to an exchange where several different market makers would then compete for best price, best execution. Now the exchange's job is really to make sure that they're maintaining a fair marketplace. This includes everything from clarifying how much volume was traded to who exactly is trading it to, the size on both sides. The broker-dealer is pulling in that data and giving it to you, everything from pricing to volume to what actually transacted. What then does the clearinghouse do exactly? Well, this is where it gets very precise on who owns the actual stock. To understand what the clearinghouse does, it's important to also know what the custodian does. Now, in the case of a normal transaction that's not crypto, a custodian would be a custodian bank. It would be another entity. In the case of cryptocurrency, it's kind of the broker-dealer, it's kind of the blockchain, but the actual act of clearing it, the actual act of confirming that the transfer went correctly, that is what they're really talking about when they talk about the clearinghouse function. In the modern day, typically you have given through hypothecation agreement the custody of your shares to the broker-dealer who holds them in street name at a custodian. You can see from this definition from Investopedia, the brokerage technically has ownership of the shares, but There's a whole series of things that it has to do to demonstrate very clearly that you, who allowed them to put it in street name, retain ownership. Now, the broker-dealer is required in the United States under SEC to segregate accounts, thereby making sure that they are marking your shares as being owned by you, even if they are held in street name at the custodian. You don't have to give custody to the broker-dealer. You can register directly with the company or just hold the physical certificate. And where a lot of folks tend to hold the certificate are with companies like Berkshire Hathaway. I'm sure Mr. Buffett has more than one stock certificate in a vault, old school style. And even today, the issuing of physical securities still happens. If you're a smaller startup and you have a secretary of your company, it may be the case that they've physically signed the stock certificates to then allocate them to shareholders. It's a real thing. But most people, for a variety of reasons, hold their certificates in street name, meaning that the broker-dealer has custody. But as required under SEC law, they have to have segregated accounts. And at no point does the broker-dealer own your stock. Now, you should be able to see this on the balance sheet as a liability of client assets held in custody. I would mention that because the broker-dealer does not take ownership of your assets, they can't use your assets to trade against you. If they did so, that would be a big no-no in the United States. Now, the second thing to note is this idea that the broker-dealer in the United States has to try to give you best execution. And best execution is a really long discussion topic, but the core components of it is that they can't just trade off of inventory or using someone else that they have in custody shares to deliver whatever it is they want to you. They do need to post it to the exchange and try to get you best execution across all the folks providing liquidity. And the exchange, being a separate entity, will track the posting of this such that if you believe your broker-dealer is doing not that, the SEC can go in and double check what happened. Some of you super nerds out there will say, well, May, you don't have to trade through an exchange. And you are 100% right. That is what the dark pool is. And part of its origin story was asset manager A just wanting to bypass the broker-dealer given the size and find asset manager B who wanted the other side of the trade for natural reasons and just have them cross off exchange. And while that's relevant in general for the topic, it's not relevant for Coinbase and Binance because you are putting in your trade with Coinbase and Binance and they're supposed to find you the other side of that trade. Again, not just selling out of their own inventory and certainly trying to make you the best price. That's what you think is happening and would be happening if they were registering with the SEC. They'd actually be required to prove that. Now, some crypto folks will say, well, the blockchain provides a record, and so it proves that. I would say wait for episode 3 because the SEC feels differently and they have whistleblowers that are also discussing why they also feel differently, having worked internally with Binance. So now let's talk about the clearinghouse function. What the clearinghouse will do is confirm who owns the shares and at what point in time they transfer that ownership. This is vital to a properly functioning market. If you put into your broker-dealer, I want to buy 100 shares of GameStop, for example, or 100 shares of AMC, then the clearinghouse is going to identify which shares it is that's crossing with you, and then they'll send out a confirm that that actually goes through. Now, in the equity markets, the confirm usually happens right away. In other less liquid markets, like parts of fixed income, you might have to wait a little bit for your confirm. Now, this is where it becomes vital that the clearinghouse function is separated and someone is double checking on the segregation of accounts at the broker-dealer. Because technically, if the broker-dealer is holding everybody's shares in custody, you could put in your little order and the broker-dealer could use shares from custody, non-segregated accounts, to post as if you actually had it and then later go into the marketplace and buy whatever they need. And this kind of activity is a big no-no and absolutely double-checked in multiple ways. Now that I've described what these 3 organizations do, I want to shift towards the type of fraud that happens when all 3 are potentially together. We talked about the clearinghouse and how that ensures that you've got some sort of timestamp of ownership. And you've got the exchange, which is really responsible for making sure that there's a fair posted price from all the different parties that are happening. And then the broker-dealer is kind of an execution arm taking in the trade and then separating accounts, not trading using your account. One of the more investor abusive types of fraud out there is this type of fraud called front running. And it is quite a bit more difficult to do it because the exchanges, broker-dealers, and clearinghouse functions are separated, each with their own regulation and each which must report a particular way so that it's easier for it to be caught. Now, what front running is in the worst case scenario is you put in your order to buy a stock, and the broker-dealer, knowing that you want it, will bid up the price of the stock by putting fake orders in to make it look like there's a ton of volume, and then they'll sell you the shares not even owning them. Then they'll remove all their orders to make it appear as if there's no volume in the stock. The stock will then drop in price, and then they'll buy the shares back from you at whatever nasty loss that happens. Now, in this case, the clearinghouse function would identify that the broker-dealer didn't own the shares to begin with and sold them to you short without a locate. The exchange would demonstrate who actually was producing the volume and what was the nature of the volume and whether or not there was a history of doing that. And then finally, the segregation of accounts would also make it very hard for them to fake like they own the share. Those are the simplest of protections because you do have another additional dynamic going on as relates to failed delivers, market maker rules, etc. I'm not going to try to get into the complication of that. That's essentially what front running is, and the SEC does actually try to prevent front running. Now, I say with varying degrees of success because there are a lot of meme stock owners that are really mad at the SEC right now because as relates to one component of this, which has to do with the fail to deliver piece on what the market makers are allowed to do, it's not great. And I will post a link to the video where I describe that issue in detail to the extent that you're watching this less for Coinbase and Binance and more to just understand how the SEC protects investors. Now, the last thing I want to say, because I saw on Twitter so many folks that felt that the SEC does nothing to protect investors on the regular. But in fact, as relates to the way that I've laid out each of these functions and what they're supposed to do in the way of record keeping and best execution, etc., the SEC does not only take in that data, but go in regularly and inspect. Also, because these three organizations are separated, and in fact, here are some public companies for each of the three different types, while they definitely work together in coordination and collaboration, they're not really incentivized to allow each other to commit fraud. For instance, exchanges do 100% compete against each other to create the best marketplace, which means best volume, best execution. People come and they don't think they're just going to get manipulated like crazy. This also isn't a complete absolution of all the regulated exchanges against any form of manipulation. It is simply that this stuff is monitored and there are data feeds that are tracking this on behalf of investors and actually on behalf of the business against another business. Exchanges compete. There's not as much competition in the clearinghouse function, but broker-dealers 100% compete against each other. And the final thing I'll say is that if Coinbase and Binance were doing this offshore, the SEC wouldn't care. It's their desire to do it onshore and the various shenanigans associated with that that has the SEC suing, number one, to get greater discovery on what's happening, but number two, to push it back offshore. That's all I have prepared for this episode. In the next episode, we're going to talk about specifically what the whistleblowers at Binance are saying that Binance is doing because these three functions are put together. And if you'd like to see that video, definitely subscribe to my channel. To see the whole series, you can click on this playlist I have on cryptocurrency or click here for the next episode.